Well, praise the Lord, hallelujah, and thank you, Jesus. It's around that time right here on KAZ Radio, where I have my most favorite show back in the air chair, none other than What's Going On with Lady D and the Anomaly, Sir John. Take it away, Lady D.
Well, welcome back and Happy New Year to all. What a great beginning of a new year, a new day. Beautiful Sunday. I mean, it is so gorgeous outside here in Cleveland.
Amen.
I mean, I just can't ask for no more. Is it really January?
Yeah, and I hope it stays this way.
I hope so too. But, you know, I always wish for no snow on my birthday in January, so I got like less than a week.
Yeah.
January 15th is the day, and I hope I can have a
I
day
can't
like
forget
today.
you and my sister had the same birthday.
Yeah, me and Martin Luther King. I always tell people,
Yeah, that's it.
that's me and Martin Day, you know?
Okay.
And then everybody else they follow.
Actually, my mother's birthday was yesterday.
Ego. All
Really?
right.
Yes, yes,
Excellent.
yes, yes,
Your
yes.
birthday too?
No, my mother's birthday was yesterday.
Okay. Well, happy birthday, Miss Oliver.
Apologies.
Yes, and thank you for blessing us with this wonderful young man here, our guest today, no other than James Oliver.
Tax
the
man.
Tax man. All right, welcome.
Thank you for having me.
How's everything going for you?
Everything's going well.
I
Everything's going.
know things have been busy for you.
It's starting to really start to crank up a little bit.
All right.
So,
So, tell us what we are looking for in the beginning of this year.
2019 and all that stuff from the tax plan that was passed come into effect this year.
most of the stuff is there's some things that are still won't be started until when you say this year, you're talking about 2018. But there's some things that don't start till 2019.
So the following tax year.
Right. So, for an example, our president wanted to dismantle the healthcare Affordable Care Act, and so technically, it is still not really dismantled. However, the obligation to pay if you don't have healthcare does not start until 2019. So, if you don't have healthcare 2018, 2017, you still pay a penalty as you did under the other previous administration.
I don't think a lot of people know that.
They
You
don't know.
mean you are penalized for not having it?
Yes.
Yeah, just like car insurance.
Yes, yes. It's actually on the tax return if you do not have it, unless your income is such a low level that you could be exempt. But the point is that you still be penalized, but because of the exception of having income under certain levels, which would be considered, like I said, very, very low, then you wouldn't have it. Then you wouldn't have to have it because you couldn't afford it. So,
So someone who is getting assistance, public assistance.
it's not only public assistance, but it is based on income. So if you're getting, yes, if you're getting public assistance and your income is over that threshold,
Okay.
then you would be taxed. You'll be penalized. You have to what's called you pay your fair share of responsibility.
Right.
And it's based on you and how many dependents you are and your income. So it varies. It's not a set amount, a level amount.
Wow, that's really interesting.
I mean, it just same as car insurance.
Yeah, well, it's
Drive
mandatory. If you
cars,
drive, you gotta pay to drive.
So it's your body. You're driving around in that.
Right.
In a
Okay.
sense.
All right, well.
Well, let me ask you a question since we're
Sure.
talking about this new tax law. Now, I think we've heard that the tax laws for the Tax Cuts and Job Acts is favors the rich. Have you heard that expression? That it
Yes.
favors-
Yes, yes.
Okay. Do you believe that's true?
Mostly.
Mostly. Interesting.
And why is that?
Because of the fact that I think it gets a little bit of everybody, including the rich. For an example,
They just get a bigger share. That's
well,
why.
but look, think of it this way. Okay, let's look at the tax rates for an example. That's one of the things we can start off with.
Okay.
But let me give you this concept. Now, we would agree that 3% over 100 would have less effect than 3% over 6%,
Yeah,
right? Because 3% over 6% is 50%.
right.
3% over 100% is only 3%. So if I average rate for the tax laws have been reduced by 3%, okay, then at the higher rate, then you do not have the same impact as you do on the lower rate.
All right.
Okay, so if we look at the new rates for an example, the lowest rate being 10%, that stays the same for the under the new rate. The old percent at 15% is now 12%.
Right.
Okay, so that has a bigger effect than the old rate at 39%, 39.6, which is now only 37%. So really, when you look at the tax rates themselves, they do favor the lower and middle class as opposed to the upper class. Another thing you think about in terms of the new tax laws, if I'm a person who can afford a $1 million home or $1.5 million home, the most I can write off at this point is $750,000. So if I buy a $2 million home and mortgage it all, I can only write off on my taxes the first $750,000. The rest of them I had to eat. Okay, but my question is, who's buying?
Oh, it's rich.
Right? So that doesn't favor them either. Okay, so it does get them in that if I'm in the position to buy that kind of home, I cannot write off the whole thing as I could previously. Okay?
The tax.
So is that something that's changed from
Yes.
last year to now this year?
Correct. And actually there was a date starting in December if you had put a let's say you had a deal in December and it cannot gone through, but at least the deal was at least written on paper. You could still go on the old tax laws.
So if you did it last year and you
Let's say you had a
don't
contract
close until this month,
year, right? That you can still get
you
that.
can still get that.
Exactly.
Okay.
Okay. So once again, that's something else that the very wealthy will have to eat the mortgages on that. So another thing that's talked about, the taxes in terms of property taxes, tax withholdings. It's been capped off this year at $10,000.
Right.
Okay, so that's the most. In other words, you take your property taxes, your withholdings from your employer, when you add that up, if it's more than $10,000, you can only write off the first $10,000. Which means, now once again, in those situations, who would probably have the withholdings higher than $10,000? Probably those people who are doing very, very well, who might have property taxes that might be $10,000 by themselves.
Right.
Okay, and now if they could afford that kind of home, then they're probably making six figures. Okay, which now means the withholdings that's being withheld, the taxes, the city taxes, state taxes, they're not able to write that off either. So it does not, in this situation, everything does not favor the rich. Another thing, for an example, look at 2017's tax rates. If I made $200,000, okay, under the old tax system, if I'm single making $200,000, I am now in the 28% tax bracket. In the new tax bracket, I'm now at the 32% tax bracket. So at $200,000, I'm in a higher tax bracket. Now, most people would not consider $200,000 as being rich,
Right.
okay, and people who say, well, okay, maybe they consider us middle class, but as you start creeping up on that amount, you're actually put in a higher bracket. So it does not favor the rich in all these categories. Now, the question is, well, where does it hurt the middle class and the lower middle class? One of the things that's been talked about is that the exemptions, we are no longer able to take, and it has been not repealed, but has been what's called reduced to zero. See, last year, when you did off your taxes, every exemption, including yourself, your wife, your children, whoever you were writing off as a dependent, you could take $4,050.
Okay.
So that amount now has been reduced to zero.
Right.
Okay. And so here's the problem with that. If I have 3 children and myself, that would be 4 under the old tax laws. And if we just round up to $4,000, that would be $16,000 that I would have to write off on my taxes, plus my standard deduction of $9,000, which would then make that $25,000 in terms of just deductions without any other expenses. Well, under the new tax law, my standard deduction has gone up to $18,000, but now I don't have any exemptions to write off. So now when I add, or you can think of the exemptions now as worth zero. So if I take my 3 children and myself, which is now zero, and add the standard deduction, which is now increased to $18,000, I'm only up to $18,000, as opposed to last year being $25,000. Remember, 4 times 4, 16 plus 9.
Right.
Okay. So if you're if you're in a family that you have many dependents, or at least more than one dependent, if you have more than one dependent, then you lose under the new tax laws.
Oh, wow, that's awful.
Okay, and so, however, there is some trade-off a little bit, so all is not lost because of the fact that even though you have, there's no exemptions to claim, you still have the child tax credit.
I was gonna ask about that, and they're gonna still get that.
Absolutely. One of the reasons why they didn't repeal the dependencies because, excuse me, because you can still do child tax credit, you can still do earned income credit, you can still get credit for students that are in college, and so those things are still available under the new tax laws. Now, with respect to child tax credit, one of the benefits that it has is that it went from 1,000 to 2,000. So it is actually double.
Is that gonna stay at 2,000? I thought it was on a scale. That was
No, it's not on a scale. It's $2,000. Now here's the thing you have to remember.
No, phased out at a certain point. If I remember.
If your income is over a certain threshold, that threshold has been raised up. Okay, so if it's over $200,000, they start to phase it out a little bit. However, once again, if we're talking about for middle and lower income people, that won't be phased out. So the other benefit that we have, or that is presented for taxpayers, is that and remember, that benefit is only for children who are between newborns to 16 years old. Once you become 17, under that particular provision, you are no longer a child. Okay, so then it's zero. However, they've added a new provision that's just started this year, saying that those who are over 17, who are still considered your dependents, will give them a $500 credit. And so one of the things you have to do in terms of finding out if that person can be a deduction on your tax return, you still have to do the regular dependency requirements. For an example, if you remember I said that the each exemption this year is worth 0. However, there is a phantom number of 4150 because in the old tax laws, one of the things that you have in determining if you can claim a dependence is what they made. And if their income, let's say for last year, was $4,000 or less, then you can claim them. Well, see, with the exemptions now being 0, what they said is that, well, we have to make an adjustment for that. And so this year would be $4,150, which basically means if you're dependent or you're student, and there's an exception, if your dependent is a student, there is no limitation on that 4150. So
does it still go
So
up
it's
to where
sort of still there, phantom-wise.
right, phantom-wise, exactly.
So, because I know it used to
Let's
be
say, for an
a
example, you have
break
a brother you're claiming or
Okay,
sister.
yes. Okay.
Okay, and
Your
so let's say, for an example, you have a brother or sister that and they work part-time.
Okay.
Okay, well, one of the things that the requirements is how much money do they make for the year for themselves. So if they made $4,150 or less, you can claim them. If they made $4,150 or more,
You can't.
you cannot. Now that's not the only requirement. You know, the other requirements is like, are they related to you? Did they stay in your house for 6 months? So all those requirements are still the same.
Okay.
But the question about how much income they made is now up to $4,150. Last year was only $4,050. So a little extra, an extra $100 to still be your dependent. And so that's one of the reasons why they kept that as a phantom, so they can make that comparison for those who are doing it, those who are not. So what are some of the other changes for 2018? One of the other changes, I mean, there's actually a lot. For an example, we talked about this a little bit last year, but it would bear repeating for this year. The 2% that miscellaneous expenses that people could write off on their taxes. Now, what falls in that 2% category? Does anybody know what those things are?
No.
Okay.
Did you write your gas and
No, not gas. Well, yes and no. I mean,
gas and clothes and things that you would need for going back and forth to work?
well, clothes are not deductible unless it's a uniform. If you work for RTA or you're a police officer, okay, then those things, yes. If you're a uniform employee,
Okay.
like I said, the post office, RTA, police and fire, then you can write off your uniforms. Or I should say, you used to could write off your uniforms.
Oh,
Okay,
Lord.
those are no more. You can write those things off. Okay, or for an example, dues. You know, union dues
Right.
As a steel worker, professional dues as a, let's say, if I'm a teacher, I pay union dues. Okay.
Social worker.
Social
Or
workers.
what about organizations you belong to, you pay dues?
Nope.
Nope.
Not work.
You know, so anything that has to do with let's say, work-related, for an example, as a plumber, as an electrician.
Okay, those
You
are
know,
professional jobs.
right, and the union jobs, okay,
Right.
and that's how they keep their employees employed because they're part of the union. They find them work, okay, and then for that benefit, you pay union
pay your
dues,
dues, okay.
and normally it's kind of substantial. For some people, they're paying $2,000 or $3,000 a year
Yeah.
to pay into that fund so they can keep their jobs or have something to do, and so that is no longer
Just
deductible.
like if they're a master, journeyman, an apprentice.
Right.
You can get jobs that way. My friend's an electrician. Yeah, the dues can be, they're expensive.
Right. So let's talk about some of the things that you can no longer deduct.
So you can't deduct that no more.
Cannot deduct that anymore.
Wow.
So appraisal fees for charity. Let's say if you have a card that you want to give and you pay an appraiser so you can get a fair value
Right.
in order to give the charity until you know what to write off. That fee used to be a deductible expense under 2%. Well, that's no longer deductible. Employee business expenses, for an example. If I am an insurance agent and my company doesn't pay for all my expenses, let's say, for an example, my travel back and forth to see clients or to pick up and drop off insurance deals, those are no longer deductible. If I take, if all my expenses are included, but let's say, for an example, if I use my computer, if I use paper, my printer, all those miscellaneous expenses as an employee are no longer deductible. So for some people, it's going to hurt very, very largely because of the fact that a lot of these companies are not paying for their expenses, and so they are able to write off $2,000, $3,000, $4,000, $5,000, $10,000.
Okay.
So if you're a subcontractor.
Now, if you're a subcontractor, it depends if you're an independent independent contractor, which you're a Schedule C, or an employee. If you're an employee, no. Let's say, for an example, auto mechanics who work for, let's say, Toyota, and they buy all their tools to do their workmanship, okay? None of those tools will no longer be deductible.
Wow.
None.
And that's pretty expensive.
That's very, very expensive. So my toolbox, all the tools I get, anytime there's a new change in a car, then I have to buy another tool.
Right. To keep my accreditation.
Yes, okay, I'm glad you brought that up.
Your license.
Your license, that's no longer deductible. So if a nurse has for stockings and to keep up her education, or anybody's education, if you're an employee and you have to have a certain amount of hours to keep your accreditations, none of that is deductible.
That's going to hurt a lot of teachers.
It's gonna hurt a lot of
officers,
people.
EMS,
Yes.
mechanics, nurses.
Right.
So where do we make this up at now? Is the employer, it's gonna be up to the employer to try to fill that void by giving an increase in benefits or pay or?
Well, at this point, I think a lot of people right now don't realize that those things are no longer deductible.
Until they
And
get
they're
ready
gonna
to
put it on-
file.
Until they get right. Now, probably what will happen is that the unions now will probably start to renegotiate on the
Contracts.
new contracts that say, hey, we used to write these things off, we no longer can. So how can you help us and help our people?
Right.
And so now that could be, maybe wage increase. It could be maybe the employer taking out some of the benefits of those things or sharing some of the cost in that.
Or supplying.
Right. And so that's something that probably will be futuristic. Now, mind you, most of the stuff that we've talked about, technically at this point, are only temporary from 2018 to 2025. So if nothing happens between that time in 2026, everything reverts back to 2017. So it has what's called a sunset provision. So like so union dues would be deductible in 2025 if nothing changes, and so.
So here, is this something that's gonna be ongoing, or is this something that they're doing is just
Yeah,
seeing how this is going, what the effects are gonna be afterwards, or for right now, this is in play for this year?
No, this is in place for now, the next 8 years, okay?
Right.
But one of the
Okay.
things that has happened is that, like I said, because of the fact it has a sunset provision, since it was temporary, I am sure, hopefully with the public outcry, there may be some changes to these tax laws
Yes,
before
yes.
it sunsets. So we won't have to wait 8 years for union people to be able to write off their union dues, or people who are uniformed, write off their, uniforms or their ammunition or whatever things they buy for their job.
Yeah, because that's a major loss. You're talking about 8 years before you get another change or to rewrite the tax law.
Right, but once again, it's what's called sunset. That's assuming that our Congress people do absolutely nothing.
Nothing.
Okay, now the likelihood of them doing absolutely nothing is probably very, very small. And like I said, if there's a public outcry, if they really hear what their constituents are saying, and they're saying, hey, we want these things back, or maybe we'll vote somebody who will put them back, then maybe that might get people to change. They might get someone to.
Where is this money going then if we're not being able to benefit from it?
Well, but that's going to increase the tax coffer, because these expenses that we were writing off on our taxes, since we no longer can write them off, that means the government now keeps more money in their coffer to do some other things. Now remember though, they have lost some money in some other things, so this is a trade-off. For businesses, for an example, if you are in a corporation, let's say an AT&T or a Xerox, you have now had a tax, and this is permanent. They had what's called a permanent change. It was on what's called a stepwise basis, but they maxed out at 35%. Well, now the most that they can pay is 21%.
So it's a trade-off, but
Because now, just think about this. If I
still
was,
gonna be losing money. The federal
if I was Amazon and I'm paying, let's say, $9 billion in taxes.
Okay.
And I went from 35% to 21%. Okay. Well, now I have to save myself $3 billion. Okay. In fact, because of that, Amazon and some of the bigger companies have said we will pass that savings on to some of our employees by giving them some extra benefits. But of course, not every employer is doing that. But so so to make up for that money that they're now losing.
$15 an hour.
Right, exactly. That's minimum wages no longer, so some of the money that we are losing on the individual side, okay, that's now being made up from the corporations who have that big deduction. And once again, those that tax cut for them is permanent, so don't have to wait. It doesn't sunset, doesn't change back
Unless they rewrite it.
unless they rewrite it. Okay.
Right.
And so, hey, one of the things I want to show you, and I guess I'm not sure, but this being kind of radio, but one of the things that our president said that you will be able to do your taxes and put it on a postcard form. So 45 said, hey, and so this is the new tax form, okay? And so now the thing is this, that you have to look at the old tax form to know the difference between the new tax form. Because in the old tax form,
Still kind of look the same.
They look-
Well, it says the 1040 up here.
right, but
Okay.
but see, what you don't see or what you're not paying attention is to what the old one used to look like. Now, remember, there was a numbering system. There was a method to their madness in terms of, if you look at 2017 back on forever, okay, line 7, for an example, on the 2017 tax return was wages. Line 8
We'll
was,
show that too. so
yes,
you can see that.
it's interest.
And Dorelli, turn that around so people
Okay,
can see it too.
and so, see, here's the thing.
They can zoom in.
What they've done is that this first part, first of all, they renumbered it. Okay, so 7, which used to be wages, is no longer wages, it's now number 1. Okay, if you see that.
Right.
Okay, and so the other thing is this, standard itemized deduction is line 8, which would be on the back of the old return.
Okay.
Okay, if you notice here, this is your signature, where you actually sign
Yeah.
the first top of the tax return. Okay, and once again, on the old form,
It was at the
it's
bottom.
on the bottom on the second page.
Right.
So really, and actually, this is 2 pages. The actual tax return from this is actually, and my software company asked IRS, can they put 2 forms together? So actually, this is page 1 of the new 1040. Okay, this is actually page 2. And so when you put those 2 together, it's now, and what happens is that because you can now sign it, it gives you standard deductions, it gives you where you can put your money at. You can, if you think about this, almost like a big postcard that you could, this is it. This is the new one. However, the question is okay, well, what about all these
Finally
other?
told
Yeah,
the
but I was
truth.
gonna say, what happened to all the little other extra papers that you would have
Okay,
attached?
and so
You
what?
no longer need those?
No, you actually still do need those
Okay.
things. And so what they've done is they made those separate schedules. So you have, for an example, Schedule 1, okay, additional income and adjustments, okay? if you notice on here, it says line 1 to 9 is reserved because that's what these lines were on the old tax return. So now, for an example, if you look at line 10 on this particular return, it's for refunds. In other words, if you itemized and got a refund from your state taxes from last year, you have to claim that for this year. That's line 10. Okay, and so line 10 is that refund here. They kept the same number, but it's on a different schedule. So alimony received, okay, it's no longer on this little page, it's on this additional income page. So,
Okay.
and so now you have additional, and we'll note for. in terms of
Additional schedules.
Additional schedules.
So it's actually more paperwork.
It's actually way more paperwork because we now have 6 more additional schedules to make up for the one page
that we had
before. So this was just, now of course, the Paper Reduction Act, you have to ask 45, how is this Paper Reduction Act? I don't really know.
It's not paper reduction.
Okay, and so,
But it was one.
So now everything is just,
okay, and so,
okay.
for an example, Schedule 2, now look how big, how much paper they use for Schedule 2.
Oh, it's
Oh,
unnecessary.
we're just killing trees.
We are killing trees. Okay, and this is for additional taxes. This is on the second page where it talks about other taxes.
Yes.
This is that page
As I am, Tom.
right there. Now, you would think, if you're going to do this, that since page 2 is so small, page 3, that they would maybe put them on the same page.
Same, yes.
But they did not. This is Schedule 2. This is Schedule 3. Schedule 3 is non-refundable credits. That belongs up here
On the old one.
on the old one. Page 4 is other taxes, okay? That's other taxes. And so now they've made them separate schedules, so you have different ones. So if you have, for an example, other taxes that you have to pay on this, now you have to add this form to this.
So everything is broken out.
Everything is broken out to separate schedules,
But it's the same darn form.
But here's a unique thing about this though. When you look through 2017, because like I said, everything's numbered. You start with 1 and you go all the way to 79.
Right.
Okay? In these separate schedules, they kept those same numbers. So if you look at the numbers on the schedules and go back to 2017,
It's
you'll be
the
able to
same
find
number.
it exactly the same place where it was on the old tax return. They preserve those numbers. This is
And you know what gets to me is somebody got paid to do this.
Absolutely, absolutely. So part of the reason I think, if they decide to change their mind, they won't have to make a whole lot of changes to go back because they've actually kept on these new schedules the exact same numbers from the old 2017. And so, and if you're a TurboTax user, I would probably be very, very cautious with TurboTax because one of the things, and for those who use TurboTax, I'm not knocking TurboTax.
Right.
Okay.
I probably won't.
Okay, but here's the problem with TurboTax. You have to. I always say this: TurboTax is a great program, but it's a generic program.
Right.
It does not address your specific situation. So it may get 70% of the questions, but what happens if you're out of that 70%? For an example, I saw somebody, and the other thing is that it doesn't tell you when you're wrong. I saw someone who prepared their tax return on TurboTax and put a rental house on the wrong schedule. They put it on the Schedule C for self-employment. And TurboTax says, hey, great, now you owe taxes, Social Security taxes on your rental property. And you're not supposed to. But because TurboTax doesn't tell you when you're wrong,
Okay.
she did not know any better. And so, once again, you need to know something about taxes if you're going to use TurboTax. I would suggest it. If you do not know, then you probably need to hire a tax professional. Because even though 45 said this is supposed to be more simpler, more
It's really
easy, it is actually much more complicated because of the fact that now, of course, by eliminating a lot of these 2% below deductions, may have eliminated some things. For an example, another thing, let me ask you a question because a lot of people get misconception. I need to write off some of these things. Tax deductions, are they tax deductions or not? Club dues,
No.
were they ever before? No, they're not. Funeral expenses,
No, they're not.
no.
Then don't nobody die.
because that's a funeral is a big expense.
It is a big expense, but it is not a deductible
Why,
expense.
why are you guys looking for deductions on certain things anyway.
Why not?
I mean, these were little gifts.
Yes.
was a gift.
Well, no, okay, now, see, I'm gonna give you my, as an enrolled agent's definition of the tax
Okay,
deductions, or my perception. The tax system, to me, is a behavior modification system, okay? So if they want you to do something, they'll make it tax deductible. If they don't want, for an example, when people are buying homes, okay, because they want people to have the American dream and buy homes and get mortgages, they
Right.
make that tax deductible, the
Right.
mortgage
Right,
interest,
right.
okay?
A benefit.
A benefit, right. For renters, because it's not, your rent is not deductible.
Right.
And so if they want to make something to push people, like electric cars, one reason they got people to buy electric cars because they made it a special credit
Credit.
that got people initiated to buy these electric cars. So to me, it's a behavior modification system
Yeah, makes sense.
that they have you to do certain things in order to get these deductions. And also, the other part of that is it's also a lobbyist.
Right.
Because, for an example, when we had the situations with the energy credits, people would agree that windows and doors would save you energy. Okay. Well, the lobbyists for the aluminum siding people did not give enough money and did not lobby hard enough with their congressional people, because it was proven, absolutely proven, without a doubt or shout, by aluminum siding your house or vinyl siding your house, you would save energy. And so, in the spirit of the law, you would think, well, if I can save energy, and since this energy credit, I should better write off my aluminum siding or vinyl siding. And because they did not pay
Their lobbyists didn't
Right.
do a very good job.
didn't do a very good job, it was not
They
deductible.
didn't bribe enough.
So in
Right.
other words, home improvements are not a deduction.
Aluminum siding.
So, home improvements, any home improvement,
Home improvements is not a deduction.
it's not a deduction
Right.
unless you do it for rental property, because remember, rental property is
Income.
an income, is a passive income. So for anything that you do for rental property is deductible. But putting those new windows in your own house, you can get an energy credit, but you can't write off the actual expense of the windows. Putting in a new driveway, not deductible. A new roof, not deductible. So home repairs are not deductible. What about life insurance? Is life insurance deductible?
No,
Not deductible. That's correct. It never has been. Parking tickets,
no,
personal
Should
living
be.
expenses. No.
no.
Okay, so and so
Yeah.
these were never deductible items in the first place. But one thing that we do know for business people, let's say with entertainment
Yes,
and meals,
yes.
are they deductible?
Not anymore.
Well, that's half true, a yes or no. Meals are still deductible to 50%, okay? But entertainment, so in other words, if I took you out, let's say to a play, and then we went to dinner afterwards,
You can write the dinner off, but you can't write
off
the play.
But I can only write the play. But the dinner can only be written off 50%.
50%, half of the cost of the dinner.
That is correct.
That's good.
So it's still 50%. But now the negative side on that is that for employers who have employees to travel for them,
Right.
to do business travel, they pay for their lodging, they pay for the meals. Well, those meals used to be 100% deductible. They're now only
50%.
50% deductible. So that's something to keep in mind. Let's talk about some other things. Contributions, has that changed at all?
No.
For charitable contributions?
No.
It actually has changed a little bit. You
Can you still write off your church
Yes.
tithes?
You can still write off your church tithes.
Okay.
It actually went up from 50% to 60% of your adjusted gross income. So if you made $60,000, you can write off $36,000 of your charitable deductions.
36,
60%.
60%.
But now here's the thing that you have to remember, and this has not changed from this year to last year, so this is not part of the new tax laws. If you write a check or give more than $250, okay, then and if you were being audited, and you showed the IRS your check where it was cash for $250 or more, $1,000 check that you gave for Women's Day, that check by itself will not be enough. You have to have more substantiation than that check. The church or the charitable
Send you a letter.
have to either give you a receipt or your church that gives the
The letter with
a list-
on the
says-
letterhead and
right,
stuff,
but it's
saying what you gave for the year.
exactly.
But they cashed it.
It is not
That-
enough, right? But once again, because
the federal banking system.
Well, once again,
Well, that's where the church treasurer, or whoever is calculating that money and keeping up with those taxes and tithes, every
Yeah.
member should get a letter by the end of the year.
But I mean,
for
it
tax
just doesn't,
purposes.
I'm just saying, it's going through a federal system.
that's true, but the
The
problem
check
is,
itself is going through
well,
the feds.
I'm not here to justify the tax law.
So
I'm
it
just
doesn't
here.
make sense.
I'm just delivering the mail.
Right.
Don't kill the
okay.
messenger.
Yeah, he's just delivering the message.
Yes, all right.
I know that, I'm just saying
So
it's
see-
illogical.
Right.
Right.
You know, but let's say you gave, you know, you saw something, a disaster, you went to give the Red Cross
Yeah.
$2,000.
Yeah.
Well, if they don't give you a letter back saying that you got that 2,000, and you have to have that letter in theory before you do your taxes. So
Yeah.
the theory is that if you get that letter, let's say the following year after you do your taxes, then that amount is still not deductible because it was given to you.
That year, you didn't, and then you didn't have it when you filed your taxes.
Exactly.
So it's not in
So this is a
void.
behavior mechanism not to give?
Well, no, it's the behavior is that when you write that check, you better get your receipt either at that time or
So
before
you
you get your
gotta do
taxes.
double duty, even
Yes,
though
sir.
it's going through a federal system
That's correct.
that monetary money
Mhm.
in this nation, it's going through that system, checks get boom boom, shows it going to Red Cross, Red
That's
Cross
correct.
cashed it,
Right.
Mhm.
And you,
and you still gotta get a letter and a receipt.
right.
And you got your bank statement showing.
Right, your
this.
bank statement, or if you go,
You got the return image of the check.
right,
Yes,
Look,
yes.
but it's no good if you don't have.
Well,
that
not say it's
letter.
no good, it is partially good, but you have to have something else to back it up with.
Okay.
So you need actually both. So that's what they want you to have, is both pieces of information together, then you'll get the deduction. One without the other is not enough.
Okay.
see, now that's something they should also revise.
Well, once again,
Yeah, because you know, a lot of people they donate to national disasters. You know, you send money to areas that have bad weather and stuff.
yeah,
you know.
but think about,
Go.
but I'm just saying, those are things that people just need to keep in mind. And I'm not trying to discourage people
No, but
giving.
you really need to keep your stuff in order.
Exactly. When how many places do churches have, like say mega churches, where they just give cash, or they come up to the altar and drop a $100
Yeah.
bill on that,
Yeah.
and so
All right.
okay, well,
So when
You don't have no
plate
proof.
pass,
right.
So you
when
better
the
start
plate
doing
pass,
stuff in a check.
no, when the plate pass, I just ask for your receipt.
Well, that's assuming that that church will be able to do that.
But it has to be a minimum
I'm just kidding.
of $250 before that even takes place.
Right. That's
So
correct.
John, you would be fine. You only give $1 a Sunday. There's only 52 Sundays in a year, so that $52, don't even worry about it.
Okay, guys. The anomaly is not
The
going to
anomaly-
church every
A dollar
Sunday.
is a dollar.
$1 is a dollar.
$250,
That
right?
$52.
A dollar is a dollar.
Okay, guys, it all adds up. Now you're gonna have to increase your
Because
giving.
you're giving John $3 a Sunday, and you'll make.
Well, I would like my receipt at the end of those.
Ooh, can you imagine that church service having a receipt book? All right.
Okay.
So what else we got going on? That was a lesson learned right there.
Right. Well, another thing, job hunting expenses will no longer be deductible. So if you're looking for a job in the same field that you're in, okay, in the past, the cost for going to the job, sending resumes, if you have to travel to get there, let's say you're going to be a teacher now instead of being in Cleveland, you want to teach in California because the weather's better, or Florida, and you go back and forth to get those, and you get the job. Okay, well, your expenses that you incurred, the travel, the lodging, the food, will no longer be deductible. That's one of those things that they've cut out. So, moving, the same thing. If you get moved and your company doesn't
Pay.
Pay for
pay
your costs
for
of
your
moving. Yeah.
moving. Now, the exception to that is if you are military and you move, you can write it off. But if you're not military, then you're not able to write it off. And so the old law basically says if you moved for a new job and it was more than 50 miles from your old place, then you could write off your expenses. You could write off the transporting of your wares, your personal effects.
Another behavior mechanism.
Well, yes.
Can you write off when you move and buy a new home and spend so much for moving, is that a tax write-off?
Yeah, that is not a tax write-off,
Okay.
unfortunately.
Oh, dear Lord.
Oh, God. I spent a lot of money to the Lord. I mean, the movers are wonderful. I was just wondering if I could get a little something back at the end of the year.
Unfortunately, you cannot. Now, another thing, for an example, I'm not sure people realize this, but the way the tax laws are written, income from any sources is considered, if it's income, if you get paid for either a service or a product, you have to claim it on your taxes. And so sometimes we do things and we make money, but it's not really a business, so we consider it like a hobby.
Yes.
And you can get hobby income, and so you have to claim that income on your taxes. But the benefit in having that hobby in the past,
But wait a minute, how do they know you got this hobby and it's an expense unless you tell
Or
them?
it's income.
well, because there's a certain amount of voluntary compliance. They depend on your
Being honest?
being honest. Or, the other side of the coin is, that let's say, for an example, you do a little part-time catering, and I said, and it's not really a business, but
Right.
maybe you do it once a year for somebody.
Right.
And so they want to write off on their taxes because they paid you $600.
You need to show it in your taxes too.
That's correct. So if they give you a 1099 saying that we
Yeah.
paid you $700,
Yeah.
okay, so then you now have to claim it on your taxes. And since it's
Yeah.
not a for real business, then it's what's considered a hobby income. Some people do, like they trade
Comic books.
comic books, So those are things that, and now the tax laws previous to 2018 says that, okay, since you did have this income, whatever expenses you incurred, like you're talking about the comic book. So if you go to a comic book convention in Florida, you could write off those expenses, but you cannot write off expenses more than your income. So a lot of times people with hobbies would just break even in terms of the income that they make, but all the expenses they have, they could write that off. One of the new tax laws, you cannot write off for hobby expenses, because once again, that also falls under that 2% on your Schedule A. And so you're not able to write that off anymore. So whatever income you have to claim, but there are no expenses you can't claim. So it's another way the government kind of behind the back door will make extra money, because now you have to still claim that income if that, let's say that place that you did the.
So in the beginning, you were trying to say this was well balanced, and more and more, I'm looking like less well balanced.
Well, no, okay, no, I mean, it's balanced, but I never said it was fair. And there's a big difference between fair and well balanced. So the tax
Tell me
system,
not sounding fair.
it has never been fair. It'll probably never be fair. However, what our congressional people try to do is says, okay, we're going to give a little bit here, we're going to take a little bit from there, and hopefully in the give and take,
balance.
Somewhere to balance
it's
somewhere.
somewhere. Sometimes that doesn't work out as
Right,
well.
right.
But that's kind of one of the things that they try to do, is to try to balance things, give and take. And so the thing that you need to do in terms of doing taxes is to be aware of what the give and takes are, and so that you can kind of plan accordingly. Can I do this or can I not do this? And so what I say to people who have these hobbies, make them a full-fledged business, because now you make it a full-fledged business. Now you can write off all the expenses, and if you are with a full-fledged business, you can have a loss, and that loss can now shelter some of your other income. So just don't make it a hobby, turn it into a business, so that you can write it off.
More
And if you-
trees.
Pardon?
More trees.
Yeah, more trees, but the point is that, but that's money in your pocket, not their pocket. My suggestion is that, would you really, really, really rather, look at it this way. If I'm going to have, and there's other benefits with that too. For an example, as if being your own business, and we talk about it in my book,
Right.
that if I have a catering business, and I now make it, instead of making it a hobby, make it a business.
Right.
Well, instead of paying maybe my children an
Allowance.
allowance,
Put them to work for you.
right, that's not deductible, have them work with you, pay them a wage, now that wage is tax deductible for you. And you also, you're teaching your child for some responsibility, work, pay, and things are not free. So there's some benefits.
So as again, one of those behavior mechanism, and also to pump the number of businesses in the United States, so they can say we have this many businesses, and they can be.
Well, there is just so much, and I know you're going through all of this, but I want the audience to know that this is just so important because
Yeah.
things are changing all the time. It is so important that you get educated on what you are doing, what can be and what can't be, and what you should consider. There is a book you have that you put out last year and came back with another one. Can we see the audience see your book? I mean, you really got to take advantage of this and get educated. Mr. Oliver, James Oliver, has a book, A Dozen
What is it?
Expense Tax
around.
Mistakes That Cost Business
Yeah.
Owners Thousands. And also, he will even go over some of the personal tax advantages and disadvantages that we all can, acquire. I just want to let you know, please tell our audience, James, how can they go about getting your book and reaching out to you, because you're really going to need him as your tax guy. This, like he says, this turbo thing, they always advertise how you can do it yourself. It's
Yeah.
quick.
But it doesn't tell you when you're wrong.
When
Right.
you're wrong,
You've already
then,
made a mistake.
things are
That's not
changing so
good.
much.
That's
James,
not good.
how
Okay.
can our audience get in touch with you and get this book?
Well, there's two ways. I am been very, very fortunate to work with for myself and work for another company that I'm going to put, not a shameless plug, but a very proud plug of. I work with a company called CLE
Okay.
Consulting Firm, and we are at this point located at 1333 Lakeside Avenue. We're in the WKYC building, the news media building. There's only 2 tenants there, and we're one of the 2 tenants, and so have the benefit to be able to overlook to see the news media, and so we're there. So the number there that you can reach me at is 1-800 or 216-800-9021. Let me repeat that: 216-800-9021, and then another number would be 216-491-9350. That's 216-491-9350.
Excellent. So I think you should probably start calling him now, because this young man is going to be so booked and so busy. You're going to wish you had him.
Yeah, that's another question. With the shutdown, how soon should people start?
Well, here's the thing with the shutdown. You have to remember that IRS is the government's biggest source for collection. And so before the shutdown came about, there was probably going to be a delay with tax season just because of these new forms, and
Right.
IRS had to retool. And so that was already anticipated way before the shutdown. And I think that if our government officials have, in their infinite wisdom, would know that they do not want to stop the progress of their biggest collection agency that they have. And so there'll probably be a delay, and I don't think the shutdown will cause an even further delay. However, because of the perception with this government shutdown going into its 3rd week, and people not knowing that they were going to be delayed anyway, they're going to blame the shutdown and say, well, it's the shutdown's the reason why IRS hasn't started. Even though there are many services that the IRS provides that you can't get through right now. Let's say, for example, you had a question, you get a notice, you have a question. A lot of those phone numbers are not working.
Right.
And so if you call them, it'll say that and so you now might have to write them instead of.
Wow.
The operators, there's nobody there to
Right.
take the question.
Exactly. And right now, quote unquote, it's a blackout period for the IRS, so you cannot electronically file a return. But I would suggest that if let's say you did your taxes today, and you said, well, okay, I cannot electronically file. What if I mail my return in instead of waiting for it to be able to electronically file? I would submit to you that if you waited to have your return electronically filed, you would still get it back faster, even if you have to wait till the end of the month, than if you mailed it in. So if you think about the mail system, for an example, let's say you do your taxes, you're just anxious, and you say, I don't want to wait for electronic filing. I think I get mine back faster. So you drop it in your post office, your little post box down the street. Okay, well now that mail is probably picked up maybe once, maybe twice a day. So let's say you did it 7 o'clock in the evening. Well, you know that the postman is not going to
To 6 a.m.
to the next day, pick up that mail. So then he picks it up and then he takes it to the post office
Sorting unit.
closest to where you live. So let's
Right.
say, for an example, you live in Cleveland and Glenville. Maybe you go to the post office at the 44108 post office. Okay, so all the mail from that 44108 post office goes to the main post office downtown. Now it goes from that main post office to the post office in Fresno, California, because that's where your refund would go to.
Right.
So then it would go to the main post office in Fresno. So it would go from the main post office to Fresno to the post office closest to the Internal Revenue Service. And it goes from the post office to the Internal Revenue Service to the mail room of the Internal Revenue
Oh my
Service.
goodness.
And so then you have people who physically have to open that mail
Yeah.
and they stick it in slots for the different person to pick it up. And so that whole process is probably easily 3 weeks right there.
Right.
Just going back and forth, before someone even actually has a chance to open it up.
Because they gotta wait till, in the main post, till it's a batch.
Right.
That's another thing, they wait till it's a batch.
Right. They don't come pick up one letter.
Right.
Right.
Yeah,
Right.
electronic is.
Right, because it'd be
the way to go
too
about it.
cumbersome to keep going back and forth all day. So they
Yeah.
rather
Everybody,
Yeah.
it's going to.
And Lord forbid they got vacation.
right, because nothing happens at that point. When they're on vacation, that person's responsible for that, and because everyone has their own things, when they come back, it's still there
They're
waiting.
here.
Right. So
Yeah,
I was,
electronic is the way.
electronically, it's definitely the way. In fact, IRS had basically said, and I should say, they've said this kind of
Roundabout.
in a roundabout way, that we will process paper returns that's not our priority. Our first priority is electronically filing.
Okay.
So if there's nothing else to do, those things that are in the mail, we'll process those secondary. So, something to note that it would be worth your wait.
Just the way.
Just
the
the
way.
way.
Right, even if it's in February, you will still get your return back faster by electronically filing than by putting it in the mail. So.
Well, that's something
This
very
is
important to know, yes.
Now, there's some other things that we could probably talk about just on a very, very brief basis.
Okay.
That one of the things that the new tax law talks about is what's called, for those businesses that have what's called pass-through income. For an example, if you're self-employed, it's considered a pass-through income because it's on the Schedule C and it passes through your 1040. Now, you have to remember, the old 1040, even the new 1040, is what's called a flow-through tax return. So, for an example, if you're self-employed, it'll show here on maybe what line is it, the new form. I don't remember looking at this one here.
So the
It's probably on
word
a
flow
different schedule.
through, you use the word flow through. Flow through, is
Me
that
goes
just
to
something?
the personal tax. For an example, let's say we were all together in a partnership.
Mm-hmm.
We had a partnership return, and we made money in our partnership. Okay, we would do a partnership return. Okay, but the partnership return itself does not pay taxes, whether it's income or expenses. It's a informational return. It says this is how much we made, this is how much we spent, and this is how the profits were divided between the partners. And so that form is put on the 1040. So it flows from the partnership to our personal return. Okay, so that's what I mean when I say flow through. So
Okay.
partnerships are that way, S corps are that way. Schedule C's, to the extent for this tax law, also works that same way. And so we are now able to get, because our 45 wanted to encourage small businesses, a 20% discount on the profits that we made. So if you made $100,000, you can take 20% off, and now it's only $80,000. And so, and I'm way oversimplifying that, because that $20,000, I don't say discount, rebate that you're getting has to be compared with some other things. But that's one of the things that the new tax law provides. And so it's called Section 199. And so that particular section, so to speak. Now, it doesn't work for corporations, because corporations don't flow through. They don't flow through to the owners. It stays within itself. So it only goes for Schedule C's and actually Schedule E's, which is rental properties. So if you have a profit on your rental properties, you might be able to get that 20% deduction. So Schedule E's, Schedule C's, S corps, and partnerships will have the benefit of maybe having an extra 20% taken off their profits, assuming some other things in that. So that's another benefit that they can possibly get with respect to that. So once again, I'm oversimplifying it because it's very, very complicated. Because once again, you take that 20% and you compare it to your other income,
Mm-hmm.
you compare it to some other things,
Mm-hmm.
and based on that, it might be reduced a little bit, but once again, it is available there. Now, you don't get, and you have to have a profit, obviously. You know, any kind of losses, you don't get any benefit from that.
Wow.
What
I'm
was the
telling
other?
you.
You said it was several things.
Pardon?
Was there another?
That's primary. I probably say that the biggest thing that I want people to know that,
That's good.
you know, so that if they have rental property, if they have a Schedule C business, let's say an LLC that they're doing their own business in, then they can look forward to having that deduction. Now, like I said, once again, I would assume
Mm-hmm.
and hope that the TurboTaxes of the world have made
Updated
adjustments.
themselves?
Right.
All right, so they got some work. They got their work cut out too. You know, I tell you, here, Mr. Oliver will be joining us for the month of February. He'll be back in March, and then we're going to also be looking forward to probably May, June. We were going to be looking forward to doing a tax workshop to give you a little bit more education. If you're interested in joining and being a part of our tax workshop, please contact me at 216-571-2235. And Mr. Oliver, I want you to give our audience the number, how they can reach you, the name of the business, and where they can get this book.
Okay. Well, they can go through my CLE consulting. We're located once again at 1333 Lakeside Avenue. Our phone number is 216-800-9021, or they can reach me at 216-491-9350. I do have my own business called JC and Associates, so
All
that's
right.
an easy way of doing that. I know we only have a short period of time, but for those who are, whether you get a professional to do it, you do it on TurboTax, one of the things that you might want to start doing right now is start gathering your receipts. And one way of trying to gather receipts is maybe go through your checkbook to see if you wrote off some things that might be deductible. And so, and hopefully you've kept your checkbook. And so, for small businesses, I would like to say for them, if you haven't done this, you need to have, and this is my first chapter, talks about 4 bank accounts.
Okay,
And so, why do you need 4 bank accounts, James? I only make $10,000.
we're not gonna give that all to them today. You must tune in and watch. Next month, when Mr. Oliver comes on, we'll be updating you and keeping you informed on what you need to do to expand your life.
And this is the year, maybe not to do the TurboTax or anything like that. Talk to a professional.
Get your professional, and thank you once again for tuning in with what's going on with Lady D and Sir John, the home of the.
Hello, everyone. 25-cent advertisement. It's good to be back.
Thank you. Please give us a call at 216-571-2235 if you want to be a guest on our show or find out more information about the tax workshop.